For most of us, our home is not just a place to live. It is the single most valuable financial asset we have ever owned. It is the place where we raised our families, weathered every storm life threw at us, and quietly built more wealth than we ever did through any savings account or investment portfolio. But here is what almost nobody tells retirees clearly enough. The Supreme Court of the United States recently revealed something about the way the IRS applies tax rules to your home that changes the financial picture for millions of seniors in a very significant way. And most retirees have absolutely no idea it happened. Today, we are going to unpack exactly what this means for you, because the choices you make right now about your home, whether you are thinking about selling it, planning to stay in it for the rest of your life, considering tapping into its equity, or simply trying to keep more of your retirement income in your own pocket, those choices carry tax consequences that are either going to work powerfully in your favor or cost you thousands of dollars you never needed to lose. The good news is that you have far more control over that outcome than you probably realize. We are going to break it all down into 4 clear, powerful pillars that give you the complete picture, the cornerstone rule for selling your home tax-free, the breaks available if you plan to age in place, the real tax truth about reverse mortgages, and the major new senior deduction that could genuinely transform your tax situation. Let's get into it. The first pillar is the absolute foundation of home tax strategy for retirees, and it is one of the most generous benefits hiding in plain sight inside the entire tax code. It is called the Section 121 exclusion. And if you are a homeowner who has watched your property value grow over the years, and most long-term homeowners have understanding, this rule could literally be worth hundreds of thousands of dollars to you. Here is how it works. If you are a single filer and you sell your primary residence, you can exclude up to $250,000 of profit from your taxable income entirely. That is not a deduction that reduces what you owe. It is an exclusion, which means that money is treated as if it never existed as far as the IRS is concerned. And if you are married and filing jointly, that benefit doubles to $500,000 of tax-free profit. For any retiree who bought their home decades ago at a fraction of what it is worth today, that kind of exclusion is not a minor footnote. It is the bedrock of what can become a genuinely powerful retirement financial event. To qualify, you need to pass 2 tests within the 5 years before you sell. The first is the ownership test. You must have owned the home for at least 2 of those 5 years. The second is the use test. You must have actually lived in it as your primary residence for at least 2 of those 5 years. For married couples, only one spouse needs to meet the ownership test, but both spouses need to satisfy the use test to access that full $500,000 exclusion. That distinction matters more than most people realize when they are doing their planning. Now, the tax code also builds in meaningful flexibility for the kinds of life circumstances that seniors actually face. A surviving spouse has a special 2-year window after losing a partner to sell the home and still claim the full $500,000 exclusion, rather than being limited to the single filer amount of $250,000, but only if the sale happens within that window. If health forces you to move before you have hit the 2-year mark, you can often claim a prorated partial exclusion based on how long you did live there. And for seniors who transition into licensed care facilities, the rules relax even further. You only need to have lived in the home for one of the last 5 years to qualify. These are not obscure loopholes. They are intentional provisions in the tax code designed specifically for the situations retirees face, and knowing about them before you make a decision can be the difference between an outstanding financial outcome and a deeply disappointing one. The second pillar is for the enormous number of retirees whose plan is not to sell, whose goal is to stay in the home they love, in the community they know, for as long as possible. And the tax code actually rewards that decision in ways that most people never take advantage of, specifically through medical deductions for home modifications that make aging in place safer and more practical. Here's the mechanics of it. If you itemize deductions on your federal tax return, you are allowed to deduct medical expenses, but only the portion that exceeds 7.5% of your adjusted gross income. Your adjusted gross income is essentially your total income after a handful of specific deductions. So if your AGI is $60,000, you can only deduct medical expenses that go above $4,500. Everything above that threshold is deductible. That threshold sounds limiting, but for retirees who are making meaningful modifications to their homes, the costs can add up quickly enough to make a real difference. The category of qualifying home modifications is broader than most people assume. Wheelchair ramps, grab bars in bathrooms and hallways, handrails along stairways, wider doorways to accommodate mobility equipment, lowered countertops, roll-in showers. All of these modifications qualify as deductible medical expenses when they are made primarily for medical reasons. The IRS's position on these specific items is that they generally do not add to the resale value of the home, which is why the entire cost can be deducted as a medical expense once you clear the AGI threshold. For larger projects that do increase your home's value, think a residential elevator, a therapeutic pool, or significant structural changes, the calculation works differently, but the deduction still exists. The formula is straightforward. You take what you paid for the improvement and subtract whatever amount it increased your home's appraised value. The difference between those two numbers is your deductible medical expense. So if you install an elevator for $20,000 and it increases your home's value by $12,000, you have an $8,000 deductible medical expense sitting right there. These are real dollars that belong in your pocket rather than in a tax bill, and they are available specifically because you chose to invest in your ability to stay safely in your own home. The third pillar addresses what is genuinely one of the most misunderstood financial tools available to seniors, the reverse mortgage, and specifically the tax treatment of the money it provides. There's an enormous amount of confusion and misinformation floating around about this topic, and that confusion is costing people either money or opportunity depending on which direction it pushes them. Let's start with the question everyone asks first because it is the one that matters most. You receive cash from a reverse mortgage, maybe as a lump sum, maybe as a monthly payment that feels very much like income arriving in your bank account every month. Does the IRS count that as income? Does it go on your tax return? Does it push you into a higher tax bracket or affect your Social Security and Medicare benefits? The answer is no. The IRS classifies the money you receive from a reverse mortgage as a loan advance, not as income. You are borrowing against the equity in your home, not earning money, and the tax code treats it accordingly. That cash is not taxable income. It will not push you into a higher bracket. It generally will not trigger reductions in your Social Security benefits or your Medicare coverage. For retirees who are trying to manage their income carefully to stay within specific tax thresholds, that is an enormously important distinction. The interest question is where it gets more nuanced, and this is where a lot of people get surprised. With a regular mortgage, you pay interest monthly and you can typically deduct it annually. A reverse mortgage works differently. The interest accumulates over the life of the loan and is paid in one large amount when the loan ends, typically when the home is sold. The deductibility of that interest depends on two conditions. First, you can only claim the deduction in the year the interest is actually paid, which means the year the loan is settled and the house is sold, not in the years the interest was accruing. Second, and this is the critical one, the interest is only deductible if the loan proceeds were used to buy, build, or substantially improve the home that secured the loan. If the money went toward living expenses, medical bills, travel, helping family members, purposes that are completely legitimate and understandable, the interest is not tax deductible. Understanding that rule before you use the money, not after, is what allows you to make the most tax-efficient decision about how the proceeds are applied. The fourth pillar is the one that the Supreme Court's recent activity on tax law has made more relevant than ever, and it is the one most retirees have not heard about clearly enough. Tax law is never static. The rules that governed your tax situation 5 years ago are not necessarily the rules governing it today. And right now, there is significant movement in the tax code around a specific category of benefit designed to give retirees meaningful additional relief, an enhanced senior deduction that stacks on top of what already exists rather than replacing it. Here is why this matters so much and why it connects to what the Supreme Court has been clarifying. The court's recent rulings have touched on the boundaries of what Congress can define as taxable income and when. That legal clarification has created both an enforcement environment, which I have discussed in other videos, and a policy environment in which new senior-specific tax relief is being designed and implemented. The enhanced senior deduction being discussed and in some form already moving through legislative action is an additional deduction available to Americans 65 and older that sits on top of the existing extra standard deduction that seniors already receive. We are talking about the potential for an additional $6,000 per person in deductions, which means a married couple where both spouses are 65 or older could be looking at a combined additional $12,000 in deductions beyond what they already had access to. To put that in concrete numbers, a single senior standard deduction could move from approximately $17,750 to approximately $20,750. For a married couple, the number could go from around $35,500 to approaching $47,500. Those are not incremental adjustments. Those are transformative shifts in how much income you can receive before federal income tax even begins to apply. The Social Security dimension of this is where the impact becomes most dramatic for the largest number of retirees. A significant portion of Social Security benefits is currently taxable for many recipients depending on their combined income. But when your total standard deduction climbs above $23,000, something powerful happens for a large share of seniors. That deduction is large enough to effectively zero out the federal income tax on their Social Security benefits entirely. The benefit they spent a lifetime earning and contributing to becomes genuinely tax-free in their retirement years. That is not a minor convenience. That is a fundamental shift in the financial reality of retirement for millions of Americans, and it is available specifically because of recent changes in the legal and legislative landscape around senior taxation. Let's bring everything together, because what we have covered today is not just a collection of individual rules. It is a connected system of tools that the tax code makes available specifically to protect the wealth you have built in your home and keep more of your retirement income working for you. The Section 121 exclusion gives you the ability to convert decades of home appreciation into tax-free retirement capital, up to $500,000 of it if you are married, with built-in flexibility for the real circumstances of retirement life. The medical deduction framework for aging-in-place modifications rewards you for investing in your own safety and independence while reducing your tax bill in the process. The reverse mortgage rules, properly understood, make available a tax-free income stream that does not threaten your Social Security, your Medicare, or your tax bracket. And the enhanced senior deduction emerging from the current legislative and legal environment has the potential to shield your Social Security income from federal taxation entirely and dramatically increase the income you can receive before taxes ever come into play. The biggest takeaway here is not about memorizing specific numbers. It is about recognizing that these rules exist, that they are specifically designed for the situation you are in right now, and that the difference between knowing about them and not knowing about them is measured in real money, sometimes tens of thousands of dollars over the course of your retirement. The question now is what you do with this knowledge. What does your personal strategy look like? How are you going to use these tools to protect what you have built and give yourself the most financially secure retirement possible? That is a conversation worth having with a qualified tax professional who understands these rules deeply, and the time to have it is before you make your next major decision about your home, not after.